Welcome to ECO351, Study Session 7, International Finance. Introduction. When goods and services move, payments have to be made. Each country has its unique currency, which is not a legal tender in another country. Payment for foreign goods and services therefore requires converting domestic currency to foreign currency. Capital also moves across country in form of private investment. In this study session, we will discuss the concept and goals of international finance. We will also discuss the concept, components, and importance of balance of payment. Learning outcomes. When you have studied this session, you should be able to 1. Discuss international finance. 2. Explain the goals of international finance. 3. Analyze the components of balance of payment. Concept of international finance. International finance entails the monetary and macroeconomic relations between countries. It deals with real-world issues such as balance of payments and policies, the causes of exchange rate movement, and implications of macroeconomic linkages between countries. International finance is a macroeconomic issue, and at times it is called international macroeconomics. Goals of international finance. Prior to the development of the study of international finance, two major goals are usually pursued. These are full employment and price stability. The achievement of these two goals is referred to as the achievement of internal balance. International finance, on the other hand, was meant to achieve external balance. External balance is the achievement of balance of payment, viability, or equality. Thus, international finance essentially focuses on the implication of external influences. For instance, it looks at the implication of borrowing from the rest of the world or from global banks like the World Bank or the International Monetary Fund. It also examines the state of the balance of payment, whether positive or negative. In what follows, we shall examine the concept and structure of balance of payment. Balance of payment account. Balance of payment is a detailed record of the composition of the current account balance and of the many transactions that finance it. Balance of payment can also be defined as a statistical record of all economic transactions, borrowing and lending between residents of a country and the rest of the world. Balance of payment account keep track of both its payment to and receipt from foreigners. Any transaction resulting in a payment to foreigners is entered in the balance of payment account as a debit and is given a negative sign. Any transaction resulting in a receipt from foreigners is entered as a credit and is given a positive sign. It means that balance of payment account is based on the principle of double entry, in which case for any debit entry there must be a corresponding credit entry. In the balance of payment reporting, citizenship and residency are not necessarily the same. The term resident consists of individual households, firms, and public authorities. However, there are some issues attached to the definition of resident. For instance, multinational corporations are by definition residents in more than one country. For the purpose of balance of payment, the subsidiaries of multinational corporations are treated as being a resident in the country which they are located, even if their shares are actually owned by domestic residents. Another example are the institutions such as World Bank, International Monetary Fund, United Nations, and development programs, and so on, are treated as being foreign residents, even though they may be located in the reporting country. Tourists are considered to be foreign residents if they stay in the reporting country for less than a year. Components of balance of payment account. The balance of payment account is made up of some sub-accounts. One of the accounts is the balance of trade. It is also called visible balance because it represents the difference between receipts on export of goods and expenditure from imports of goods. Export receipts are recorded as credit entries, while payments for imports are recorded as debit in the balance of trade account. Balance of trade position can be surplus or deficit. It will be surplus when the proceeds from exports are greater than import payment. When import payment is greater than export receipts, we have balance of trade deficit. Current account. This is the totality of visible and invisible transactions. It is the combination of visible balance, which is trade balance, and invisible balance. The invisible transaction include receipt from export of services and payment for import services. Services, export and imports include shipping, tourism, insurance, banking, interest, dividend, portfolio services. Universal transfer. This is an aspect under the invisible account. It is the payment or receipt that has no corresponding receipt of payment. An example of this is workers' remittances, payment of pension to foreign residents, and also foreign aid. Unilateral payment reduces domestic income, while unilateral receipts increase domestic income. Hence, payments are recorded as debit entry, while receipts are recorded as credit entry in the balance of payment. Capital account. Capital account contains records of transactions involving the movement of financial capital. That is, capital account records all international purchases or sales of assets. Asset is any form of wealth which can be held, such as money, stock, factories, government debt, land, or even common postage stamp. When an asset is sold or borrowed, it is called capital inflow. When an asset is purchased or left, it is called capital outflow. Capital inflow is recorded as credit in the capital account of the balance of payment. This is because assets sold is like exporting assets to the foreign countries, thereby decreasing the country's holding of foreign assets and at the same time increasing the liabilities of foreigners. Capital inflows in form of investment can be considered as export of equity and bonds, which will be redeemed, and hence it is entered into the capital account of the balance of payment as credit. Also, when a country borrows from abroad, it must be treated like sales, a promise that such money will be paid in the future and therefore should be recorded as credit in the capital account of the balance of payment. Thus, capital inflow includes sales of foreign assets, sales of domestic assets owned by foreigners, and borrowing from abroad. Capital outflow is recorded as debit in the capital account of the balance of payment. Capital outflow include lending, purchases of foreign assets, and purchases of domestic assets by foreigners. Capital account items are classified as either private or public, or either as short-term, medium-term, or long-term, depending on the source of capital or fund. Again, the items can be classified as bilateral or multilateral, depending on the number of countries involved in the transaction. For instance, capital flows between Nigeria and the United Kingdom only are bilateral, while capital flows between Nigeria and countries like United States, China, United Kingdom, or more is multilateral. Capital account is actually balanced if the total value of inflows is equal to the values of outflows. If outflows are more than inflows, it means total value of negative entries are greater than positive entries. That is, total purchases of assets is greater than sales of assets, and this builds up the country's liabilities. If a country's capital account balance is in this situation, we say the capital account is in deficit. Conversely, when inflows of capital are greater than outflows, the country is running a capital account surplus. However, when the two is summed up, it must equal to zero. Thus far, we have treated two important components of balance of payment, the current account and the capital account. An interesting scenario is that it is possible to run current account deficit while running capital account surplus, or vice versa. What is important is that in a balance of payment containing the two components, when one is in deficit, the other must be in surplus. Statistical discrepancy accounts is open for any difference between current and capital accounts. That is, it shows the amount remaining for current and capital account to balance. It is in view of these that balance of payment must balance. Table 7.1 below shows the schedule of a hypothetical balance of payment. As can be seen, the table contains three broad components. All receipt entries are credit, while all payments are debit. The current account contains export of merchandise and investment income received. Investment income received can be viewed as compensation for the services provided by foreign investment. For instance, our footballers are in Europe and England to provide services. Besides, some Nigerians own businesses overseas. All these can be perceived as export of services from Nigeria to Europe and United Kingdom, and therefore must be entered into the current account as credit. Also, the presence of foreign firms in Nigeria is perceived as imports of services and should be featured as debit in the current account. The additions of items 1, 2, and 3 gives the current account balance. It could be negative or positive. The addition of 4 and 5 gives capital account balance. It could also be deficit or surplus. The last item is the statistical discrepancy, which adds up all the items by reversing the sign. Classifying balance of payment items. Theoretically, balance of payment account always balance because transactions have both credit and debit entries. However, individual account may not balance. That is, capital account can be surplus, while current account can be deficit. Mere recognizing the net difference through statistical discrepancy is enough to suggest any policy direction. In order to make this possible, there are two terms used to define balance of payment surplus or deficit. These are autonomous items and accommodating items. Autonomous items are transactions that occur independently of balance of payment. Accommodating items are those transactions which finance any discrepancy between autonomous receipt and autonomous payment. Thus, in this context, the surplus in the balance of payment is defined as excess of autonomous receipt over autonomous payment. In the other hand, balance of payment deficit is the excess of autonomous payment over autonomous receipt. However, there is a serious disagreement on the specific item to be grouped as autonomous or accommodating because it is difficult to identify the purpose of transactions. For example, if a short-term capital flows in response to higher domestic interest rate, it is unclear whether it should be treated as autonomous or accommodating item. Another example is where a short-term capital inflow is used to finance import demand. It may be treated as accommodating or autonomous items. Due to the complexities and disagreement in classifying items as accommodating or autonomous, another concept emerges. This concept views surplus or deficit as arising from foreign account. The current account surplus indicates that the country's stock of claims from the rest of the world is increasing, while a deficit in the current account shows that the country's net claim on the rest of the world is reducing. Current account is important because it reflects changes in economic variables such as variation in real exchange rate, domestic and foreign economic growth, and relative price changes. Summary. In this study session, you learn that international finance deals with issues such as balance of payment and policies, the causes of exchange rate movement, and implication of macroeconomic linkages. The goal of international finance is to achieve external balance, which deals with balance of payment, viability, or equality. We also discuss balance of payment as a detailed record of the composition of the current account balance and of the money transaction that financed it. Good inflow and capital inflows are recorded as credit in the balance of payment, while outflows are recorded as debit. Theoretically, balance of payment should be balanced, but in the real world, this may not be the case. Thus, accommodating and autonomous items are always referred to. Unfortunately, due to complexities in recording items as accommodating or autonomous, it was conceptualized that surplus in the current account represents increase in claims over foreigners, while deficit is an increase in foreigners' claim over the reporting country's asset. This is the end of study session 7. Thanks for listening.